Every startup starts with a clear vision, an idea strong enough to challenge the norm and attract early support. But having a vision alone isn't enough to keep a startup running. In the early stages, the most critical factor is cash, specifically how fast a startup spends it, known as the burn rate, and how long it can keep operating before the money runs out, called the runway. These two metrics are essential not just for understanding finances but as tools that help founders make important decisions, like when to scale, hire, or raise more capital. They also serve as early warning signals that guide how to navigate risks, especially when market conditions are tough or investment is needed. By knowing their burn rate and runway well, founders can plan strategically, build investor confidence, and manage their startup's future with greater confidence and clarity. Investors look closely at burn rate and runway because these numbers tell them how well founders manage their capital, whether the business model can last, and how soon the company will need more funding. When a startup has a long runway, founders have more leverage in negotiations, but a short runway often means they might have to accept less favorable deals. Tracking burn rate also helps teams understand their cost structure, spot any unnecessary spending, and make sure their expenses align with key priorities. This builds financial awareness, which is essential for early-stage companies. Additionally, knowing the burn rate and runway lets founders plan for different scenarios, like potential growth, economic downturns, future hiring, marketing budgets, and product investments. This kind of planning turns uncertainty into more manageable, data-driven decisions. To get started with this, burn rate is simply the cash a startup spends monthly, and there are two types, beginning with gross burn rate. Total monthly expenses are summed up in what we call the gross burn rate. This figure represents all the money a startup spends each month. More critical, however, is the net burn rate, which tells us how much cash the company truly loses each month after accounting for any revenue it brings in. It's calculated by subtracting monthly revenue from monthly expenses. Understanding net burn rate is essential because it shows the real financial pressure on the startup, making it a key metric for survival. Then there's runway, which estimates how many months the startup can keep going at the current net burn rate before running out of money. You get runway by dividing the cash in the bank by the net burn rate. For example, if a startup has £600,000 in the bank and a net burn rate of £50,000 a month, that gives it 12 months of runway. It means the company has a year to adjust, by increasing revenue, cutting costs, or raising more capital, before it runs out of cash. A real-world example is Airbnb during the early COVID-19 pandemic when their revenue dropped sharply and expenses stayed high. To stay afloat, they cut marketing, reduced their workforce, raised emergency funding, and changed their focus to longer-term stays, effectively extending their runway during a critical time. By managing their burn rate aggressively, they were able to extend their runway and eventually recover, leading to going public in 2020. WeWork is a good example of the risks of a high burn rate combined with weak business fundamentals. Despite raising large amounts of capital, their rapid expansion caused massive spending that far outpaced revenue, leaving them with a short runway. When investor confidence dropped, they had little time to adjust, which put the company at existential risk. On the other hand, Basecamp took a very different approach by maintaining a low burn rate through staying small, avoiding unnecessary hires, and growing organically. This allowed them to have a long runway and independence from investors, proving that a low burn rate can be a deliberate strategy, not just a survival technique. Looking at a typical early-stage SaaS startup, if they raise £1 million in seed funding but spend £80,000 a month while generating only £20,000 in monthly revenue, their net burn would be £60,000, giving them a runway of about 16.6 months. This timeline helps founders set clear milestones before needing to raise additional capital. Overall, tracking burn rate and runway provides clarity and focus by turning complex financial details into practical insights and acts as an early warning system to detect problems before they become crises. Understanding burn rate helps founders communicate more effectively with investors, showing that they manage their capital responsibly and can be trusted. It also supports strategic planning by helping teams match their goals with the resources they actually have. Keeping a close eye on burn rate encourages financial discipline, which prevents startups from spending money wastefully. However, there are some potential downsides. Focusing too much on burn rate might lead founders to make fear-driven decisions, such as underinvesting in growth, delaying important hires, or being too cautious. Also, a high burn rate isn't always negative, especially when funding product development, market expansion, or customer acquisition, as many successful companies have burned through cash initially before becoming profitable. Finally, Runway calculations assume things stay the same, that revenue and costs remain steady and no new funding comes in, which isn't always realistic in a dynamic business environment. Startups change quickly, so it's important to remember that burn rate and runway can be misleading without context. For example, a startup with £500,000 in the bank and a £50,000 monthly burn rate seems to have 10 months of runway. However, if its revenue is growing by 20% each month, that runway can extend naturally over time. Investors often push for a lower burn rate, but this pressure can sometimes conflict with the need for strategic investment to drive growth. Burn rate and runway are not just financial numbers, they influence how founders make strategic decisions, build investor trust, and manage their operations. When founders understand these metrics well, they can balance ambition with discipline and growth with sustainability, giving their startups a better chance to survive, adapt, and ultimately succeed. On the other hand, ignoring these metrics can lead to running out of resources before reaching full potential. While knowing burn rate and runway doesn't guarantee success, not understanding them almost guarantees failure, making them essential tools for any founder serious about building a lasting business.